Hey everyone, I know Salesforce has been making headlines lately because of its potential acquisition and the stock price is down as a result. But let's take a closer look inside Salesforce, what's going on lately, and why the company feels this acquisition might be needed or might be warranted. But let's take a look at the performance that's causing this expansionary attitude for Salesforce. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So the company saying in their latest quarterly conference call that there is no other time in our history that rich data and metadata, I should say, together in one place is so important because that's what you're going to need to drive this artificial intelligence. And of course, artificial intelligence has been all the rage lately with enterprises, institutions worldwide trying to get their hands on better AI capabilities. But of course, data is the foundation of those capabilities, and Salesforce management acknowledging that. Bringing together that data is what will fuel artificial intelligence. And of course, Salesforce has some of the most vital data there is, right? The customer relationship data. How effective are your marketing campaigns? That's essentially what keeps people in business, being able to get customers to purchase your products. If you send out an email, how many people open that email? If you send out an email with a link inside to make a purchase, how many people click that link? If you have an advertising campaign or if you have a promotional campaign offering 40% off a certain product, how much did that increase your sales in the 2 weeks after you launched that campaign? Those data, those history, those customer interactions are some of the most vital pieces of information that a company can have. If they can get information about those promotions to know which ones to offer, when, what times, how to tailor it to certain customers, that could determine actual sales and profits and cash flow, right? We've been a little bit caught up with the large language model and how, you could go on to chat GPT and ask a question and it'll answer you, but that's not where the primary value could come from with artificial intelligence. The primary value could come from businesses and the proprietary data they have, and turning that proprietary data into intelligence that can inform decision making. And the AI will allow companies to engage with that data more efficiently, more effectively, and get responses, get insights from that data. So exciting times here for Salesforce, and understandably so. So the CEO saying that, just wanting to make a point that for the full year they delivered 34.9 billion in revenue, which was up 11% year over year, one of the best performances of any enterprise software company ever. Not only did revenue grow, but margin expanded. Non-GAAP operating profit margin for fiscal year 2024 increased by 800 basis points to 30.5%. Remember, Salesforce about a year and a half ago implemented that cost-cutting plan where they let go of thousands of employees and cut costs. That's paying off now, as you can see, after a full year of performance where revenue increased by 11%, boosting operating profit margin to 30.5%. Operating cash flow reached 10.2 billion and operating cash flow was up 44% year over year. So those enhancements the company made truly starting to show up in its performance, in its revenue, in its cash flow. Additionally, CRPO, which stands for Current Remaining Performance Obligations, increased by 12% to 27.6 billion. Total remaining performance obligation ended the fourth quarter at 56.9 billion, an increase of 17%. And notably, that increase of 17% was larger than the company's latest revenue growth of 11%. That's always a good sign when a company can increase their remaining performance obligations at a faster rate than revenue. Now, to provide a little explanation on what remaining performance obligation is, that's when a company signs a contract with another company to perform a service, but they haven't performed that service yet. So let's say Salesforce signs a contract for 3 years at $1 billion with some large company. Salesforce doesn't recognize that $3 billion contract as revenue immediately. Generally accepted accounting principles call for the company to prorate that revenue across, or prorate that contract, I should say, across its performance timeline. So if it's going to serve that $1 billion contract over 3 years, then it needs to split up that $1 billion over 36 months and recognize revenue monthly based on that proration. And so over 36 months, it'll eventually recognize that 1 billion in revenue. But initially, that 1 billion contract will go in as a remaining performance obligation. And then eventually it'll turn into revenue. That's why these remaining performance obligation numbers are so critical for Salesforce investors, because it informs us what their revenue is going to look like over the next 12, 24, 36 months. And when remaining performance obligation is growing faster than revenue, that indicates that revenue growth is on an upward trajectory, right? Because its contracts, its remaining performance obligations are increasing, and revenue is just growing at 10% while RPO at 17. That means eventually those RPOs will turn into revenue at an increasing rate because it's going larger than the existing revenue. So that's good news for Salesforce stock investors. And for fiscal year 2025, the company is forecasting free cash flow to grow between 23 and 26%. That's phenomenal growth in free cash flow, and revenue growth to 38 billion, about 9% year-over-year growth. So revenue growth will slow down slightly from the 11%, suggesting that most of this remaining performance obligation comes from longer term contracts that are spread out over longer time periods, suggesting each year will be lower incremental revenue, and those revenues will come in longer term. And then finally saying that they're committed to delivering non-GAAP operating profit margin of 32%, which, if you remember, non-GAAP operating profit margin for 2024 was 30.5%. So still upside remaining for Salesforce to expand its operating profit margin from the already boosted 30.5 operating profit margin it delivered in the latest period. And let me show you a chart of just how successful Salesforce has been in boosting its operating profit margin over the last decade. Clearly demonstrated economies and scale here as they're expanding revenue, as they're digesting the myriad acquisitions they've made. Their operating profit margin is drifting higher and higher still. So you can understand why Salesforce is feeling acquisitive. They've had success in the past with their previous acquisitions. Their business is growing, contracts are expanding, profit margins are expanding, and they feel like they can handle more, and they're going out and they're gaining more by making these, well, I should say potential acquisition, or interested in making the acquisition. And this isn't a surprise. They've been doing this for several decades now. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.